All right, we're recording. Hey, everyone. My name is David Barnett, and I want to thank everyone for tuning in and joining me here today. Um, Today, we're going to be talking about the different levels of cash flow. And it was interesting. There was a gentleman named Paul during the previous session who asked a question about adding back the owner's salary. And this is specifically the kind of thing that we're talking about when we talk about levels of cash flow, because there are different levels of cash flow that we talk about when we're looking at buying a business. And so let me advance the slides here and give just a brief outline about who I am. So my name is David Barnett. Went to business school. I've bought, started, and operated 5 different small businesses. I've sold 2 of them, and I've closed 2 of them. So I've been through ups and downs in this world. One of the businesses that I owned was a business brokerage, and this was actually during the Great Recession period, from the end of 2008 until the end of 2011, where I sold 36 companies here on the east coast of Canada. Today, and for the past 5 or more years, 5 years at least full time, since about, well, actually 7 years full time. I've just been working as a consultant with buyers and sellers of businesses to help them analyze deals or help them look objectively at their businesses to figure out what they might be able to sell them for. Um, I run online education programs, I do group coaching programs, and I've written several books on the topic. And here are some of the covers of the different titles I have. And if you download that package from Gumroad, you may find a free gift that you might recognize here. Um, so let's get started. So where do these different terms come from? EBITDA, EBIT, SDE. Different professionals in the financial industry who do analysis, they wanted to be able to compare one company to another. And so they literally made these things up. And so, in the world of financial analysis, we have literally what we call these notional cash flow levels. And so, what does notional mean? Sorry, some of my animations don't seem to be appearing, but notional simply means figurative or made up, is the definition. And so, the government doesn't care what your EBIT is. The government doesn't care what your EBITDA is. You don't pay income tax on any of those things, right? The everyone that your business is going to interact with, they do not look at these different things. It's only when it comes time to selling a business or analyzing a business or looking at a business that we start to wonder about these different notional levels of cash flow. And so what we're going to do today is we're going to look at them and we're going to explore what the difference is between them. And we're going to answer some of these questions that buyers often come up with. So back in the 1970s, business brokerage started to grow as an industry, and little businesses, small businesses are different than large publicly traded companies. Large publicly traded companies tend to have audits, they have internal auditors, they play by the rules. If you listen to Mike's presentation, the one that came before mine, you'll remember he talked a lot about, business owners that do fishy things with their business to try to minimize their taxes, for example. And so when business brokerage was developing as an industry, people recognized that the management of these small businesses, the owners, often would do these extra items, these extra things to try to minimize taxes. And in a way, what they were doing was underselling the profitability of the company to minimize taxes. But then when they wanted to sell the business, of course, they wanted to um, be able to be recognized for all of those earnings. They wanted to be able to have that justify the asking price that they were looking for. So the question was, how do we demonstrate the true cash flow available to a buyer, is what people were saying. So the first thing that business brokers would do is they would add back, what they would call non-cash expenses like depreciation and amortization, because theoretically, when you see depreciation on a P&L or an income statement, it's not a bill that you got that you had to write a check for. It's some kind of accounting thing, and we're going to dig even deeper into depreciation here today. And then there were these discretionary items, things like having your teenage daughter's cell phone be a company cell phone, or going on vacation travel, but writing it off as business travel, right? And so people would then start to add these back as well. And taxes and interest also ended up in this same bucket as discretionary. And the question of why would you add back interest is, well, the argument that I was taught anyway when I was becoming trained as a business broker is that we don't know how the buyer is going to finance their company. So we don't know what kind of interest rate they're going to pay. We don't know what their finance charges are going to pay. So we're going to add back whatever interest the seller had, and that then becomes part of this cash flow, this notional cash flow available to the buyer that they're going to be able to use to handle their expenses in acquiring the business. And taxes, the reason why that was added back was, of course, because everyone in this industry started to realize that taxes were discretionary based on how you manage the business. If you jammed more personal expenses in and called them business expenses, your tax bill would be lowered. But if your business entity is not a pass-through entity, like if you're in the States and it's a C corp, or if you're in Canada with any kind of corporation, um, whatever you do to increase the expenses of your business, even if you took it out personally and paid yourself a bonus, while you personally may face income tax on that, you've reduced the tax burden in the company. So, in that respect, the tax burden can be manipulated or controlled through management decisions. And so it was added back as well as a discretionary kind of expense. So let me move along here. So let's take a look. Well, I guess we can't take a look at a sample normalization. It's not appearing on my screen. Here, just a second. I'm going to try and do this again. Uh, can you guys see me? Sorry, guys, I'm having problems with my slides. um, let me try this again. Okay, play from beginning. Move that over here. I'm gonna do something different because I want you guys to be able to see these images. Sorry, I apologize. Let me relaunch PowerPoint here. Okay, I'm going to share my screen. Okay, so this is what I wanted to show you guys before: notional. So the definition of notional. I'm sorry, I'm not sure why my images weren't showing before, but according to the dictionary, it exists only in theory or as a suggestion or an idea. And that's where our SDE and our EBITDA and our EBIT exist in reality. These are notional, they're made up. So enter business brokerage in the 1970s. I went through this slide, but here's something that didn't appear before. I made a video called Why SDE is Not Cash Flow. And one person left a comment and said, so SDE is a sales gimmick to make it seem like the business is making more money than it actually is. Is it? Well, I don't think so. And here's the problem is that the creation of SDE, seller's discretionary earnings, does solve a problem. It gets back to the original financial analysts who whipped up EBIT and EBITDA and all the other ones. Is if you're trying to compare two different businesses, two different laundromats, for example, you want to know at what point up the chain of expenses and earnings do you have an earnings number that you can then take control of and direct where the money goes. So I understand the utility of SDE. The problem is that it is often presented like this comment would suggest. It's often presented like this is the money that's going to end up in your pocket. And it is definitely not. And that's what I was talking about in that video. So, how then should we be using SDE and what are the problems or concerns that you're going to be able to find out? Nunzio, I was trying to, and it wouldn't show the images when I was in presentation mode. So here's an example normalization. Okay. So we can see here under the reported column, this is what actually appeared in the financial statements of this business. And so they've got sales and cost of sales and all kinds of other things. And then these adjustments are the normalizing adjustments that a business broker, for example, might do. So, right up here at the top, there's 40,000 and it says additional sales. So these are like sales that are not reported in the regular figures. This is the kind of adjustment you might see from a business broker, for example. And then down here, you've got on the wages and benefit line, there's an adjustment here to take $45,000 out of that expense, and it says adjust the manager's role out. And in this particular template, the manager's money was put back up on this line so it could be treated differently for the purposes of differentiating between SDE and EBITDA, which we're going to get into in a minute. And we can see here a bad debt event, which was added back because they say it was a one-time expense. Down here, property taxes and rent are adjusted. You can see this was a case where the business seller owned the building. And so what happened was some of the expenses related to owning the building were added back, but then the rent, which was 6,000, was increased to 33,600, which is the rent that the new owner would be paying. Okay. And then we have a discretionary amount of 2,400 on the telephone line. So that's probably a couple of extra cell phone lines that have nothing to do with the business. And then travel and auto, estimate of annual discretionary. So you can see here in this example, this business went from $80,000 of regular net income reported for tax purposes. And then they're saying in reality, the owner enjoys 186. Here's some more points about SDE. So it's called seller's discretionary earnings. I've also seen it called adjusted EBITDA, and I've also seen it called EBITDA with an O at the end, meaning EBITDA plus the owner's pay. It's the total amount of money available to one owner operator who works in the business full time as the manager. And so the reason I've underlined the word one is one of the most common errors that I often see when I'm looking at SIMs and business profiles that are created by business brokers is that if there's more than one owner working in the company, they'll add back all of their wages to create the SDE. And that's not correct. SDE is for one owner operator. That's it. So if the owner's spouse is in the business and being paid 75 grand, doing a job that a stranger would do for 40, you're supposed to add back the 75 and then put an expense of 40 and note it as this is the cost, the replacement cost to hire an employee to do what the spouse is doing in the business. So while the spouse is getting extra money that would be part of the business owner's profit, we still need to leave the expense in before the SDE line. And then this was supposed to appear afterwards after I clicked the button. But I just want to highlight that the definitions of words that we use in the small, medium-sized business space are different than the language being spoken on Wall Street. So when I went over to Investopedia just to look up seller's discretionary earnings to see if there was an entry there, I found discretionary cash flow. And this blew me away. It says the money left over once all capital projects with positive net present values have been funded and required payments have been made. So, in the world of big corporations, they only consider money to be discretionary once they have accounted for capital projects. But seller's discretionary earnings adds back depreciation and amortization, which are the things that are driven by capital asset acquisition in a business. So the discretionary term in the world of Wall Street versus the world of Main Street is completely different. And I have run into many MBAs who have gone through different programs and they're looking at buying a business. And I've pointed things out to them that actually stem from some difference in the way that words are understood between the two worlds. So it's something that I wanted to point out to everyone here. The Let me reiterate with this other slide because it makes it a little bit easier to understand with these blocks. So if you have the total revenue of the business is this yellow bar, on the left-hand side, we have we have expenses. I'm not used to giving presentations with this view open. Sorry, guys. The the uh, the bars here that the blue expense block is the expenses, and then we have a manager's salary. So think of an owner operator who works full time in the business, and the profit of the business. Both of those light blue blocks together make up the seller's discretionary earnings. Now, to get to Paul T's question that he asked in the prior session, what about that manager's salary? Well, over here, you'll see that the manager's salary is included in the expenses when we're considering EBITDA. So EBITDA is the earnings before interest, taxes, depreciation, and amortization. It's a discretionary cash flow to an investor who pays a manager and they have to pay them money. And so the EBITDA is the amount of money that a strategic acquirer or investor is looking at when they're going to pay someone to run the business for them. So these two different levels of cash flow are meant to answer the questions of two different kinds of potential buyers. When I was a broker and I was putting business profiles together, I would always have both of these and demonstrate them because I wanted to create a package that could be looked at by both kinds of buyers, right? And so here are the two, most commonly used ones. Now, let's take a look at our normalization again. So what we did here is we added back amortization and depreciation. The interest expense has been added back. We added back the fair market. We have the fair market value of the owner on one line here, according to what the seller told us he was paying his manager. Okay. And so what we end up with down here, this 186, we then add that 45 and we end up with an SDE of 231. Okay. So this is what would be presented out there as the cash flow of this business. They would say $956,000 in revenue and $231,000 in cash flow, or SDE is what would be represented. So what do the brokers do? Well, we've already covered some of this. They're going to add back interest, taxes, depreciation, amortization, and the perks. Good brokers are going to introduce expenses that are not recognized. So, like that rent adjustment, or if, and I've seen this before where people own multiple businesses where there's one forklift, it belongs to one business, but the other businesses use it. They just go take it and use it and stuff. Well, if you're going to sell one of those businesses, you need to add an expense for that business to rent or lease or somehow get a forklift because they're going to need one of their own. They're probably not going to be able to keep borrowing one from another business that doesn't have common ownership anymore. Really good brokers will normalize things like rent and other items related to balance sheet adjustments. So if you remove the real estate from the business, you have to add back a rent figure, and then the broker will go and look for data to justify a certain multiple, and then they'll multiply the SDE by the multiple and come up with the price of the business. So I have an example here: $231,000 times 3 He was 695. And so at 695, what do? Is you round up to a cool 799 to leave room for negotiation, right? So who's experienced this kind of thing before? Probably many of you have, as buyers have, right? So that leaves the question of, what level of cash flow should we be looking at? So typically, when you're looking at a business that has an EBITDA of $500,000 or more, that world is entirely talking about multiple of EBITDA. They're not talking about SDE, or they shouldn't be. Okay. Because what happens is, as the businesses get bigger, the operators and owners become more sophisticated. They begin to understand the difference between the value of somebody's labor working in the business, managing it all day long, versus the cash flow created through investment in the enterprise. The smaller business buyer tends to mix their investment with their labor. They'll say, if I buy this business, if I pay the money, how much do I get? And that's kind of the question that SDE is trying to answer for them. Businesses that are small retail or service companies, it's typically multiples of SDE. That's what we've been talking about. And even though you are going to want to take a salary and everything, we're still going to be using multiples of SDE because that's where all the data is. So there's thousands upon thousands of laundromats that have been sold, and those transactions have been recorded, and they're all recorded as multiples of SDE. So if we want to examine the marketplace and we want to look up and find out what other businesses have sold for, we're going to be looking at multiples of SDE. But businesses with lots of equipment, things like trucking companies, excavating companies, paving companies, they have a lot of real cost related to equipment, and equipment wears out and equipment needs to be replaced. Okay. And that means we need to consider the depreciation and amortization in a big way up front when we're looking at valuing these businesses. So in this case, we want to look at multiples of EBIT, but there's a problem with this. Okay. So, how should the buyers use these notional cash flows? Here's how. And sorry, these are supposed to slide in one at a time, but I don't know why PowerPoint's not working today. Maybe I should move to Mac, right? So the notional cash flow multipliers, guys, are benchmarks only. These are not, the word of God. These are benchmarks. And there's so many other variables all around the transaction that are going to have an impact on whether it's a good deal or not, regardless of the multiple. So I regularly work with buyers who find a deal that seems to be well priced because the multiplier seems to make sense, only to discover that it doesn't cash flow once all these ignored expenses are then accounted for. Okay. And people will also make this other mistake here that I point out at the bottom. People will often overpay for a business when they don't account for operating capital needs. You see, those multipliers that we often find when we're doing research or reading articles or seeing different things, they're reflective of what's called enterprise value. And enterprise value is supposed to be the amount of money that you pay to buy everything you need to make a business go. And there's some portion of operating capital that is required to make a business go. So if you buy a business for $1 million, but then you have to put another $200,000 in for operating capital needs in order to make it function, guess what? You just invested 1.2 million. So if 1 million represented the fair price, you just overpaid for the business, right? And so there's a video that I made on YouTube a couple of years ago that sort of addresses this a little bit more. Is the inventory added or included in the cash flow multiplier? That digs a little bit deeper into this topic. And again, if you download the slides, that hyperlink will work for you, and it'll go right to the video. And so let's examine this problem with EBIT, because I alluded to it. I've got it on the slide there. You probably can't read it, so I'll read it to you guys. This is the actual notice from an accountant from a set of financial statements. And it says, on the basis of information provided by management, we have compiled the balance sheet as of September 30th, 2020, and the income statement and retained earnings and cash flow for the year ended. We have not performed an audit or review engagement. Now, most people stop reading right there and they say, okay, I get it. The accountant did not validate, verify, scrutinize the numbers in here. They were provided by management. But the real key is the last line. The real key is the last line, which says readers are cautioned that these statements may not be appropriate for their purposes. Financial statements from small businesses are only created for one purpose, and that is to avoid liability or avoid getting into trouble with tax authorities. So people go to their accountant, and yes, sometimes they've hidden personal expenses in there. They create the financial statements, they create the tax returns so they can pay the taxes. They're not creating them to be information for you to buy the business. There's some stuff in there that we cannot rely upon. And we're going to talk about that because the biggest one is the depreciation. And if you're going to look at EBIT and you can't rely on the depreciation, what are you going to do? Let me give you an example of why you can't rely on depreciation. So here is a typical depreciation rule for a truck. 30% declining balance, half first year rule. What does that mean? It means that you buy the truck for 100 grand and every year you're allowed to depreciate that value by 30% and then the next year another 30%, but in the first year you can only do half. So in year one, we've got $100,000 of book value and then depreciated half of the 30%, which is 15 grand. And then at the end of the year, it has an $85,000 remaining book value. The following year, it starts at 85. We can depreciate it the full 30%. That's $25,500. And at the end of the year, it's got a $59,500 remaining book value. So if you're buying a small business and they own one truck, okay, and you happen to come along in year 6 and look at their financial statements and you want to look at the EBIT, the depreciation on that year's financial statements will be $6,100. But if you came along 3 years earlier, the depreciation would have been 17.8, right? And so in the world of big companies, like if you imagine a trucking company with 500 trucks, those financial statements, they're replacing part of their fleet every year on a continuous basis. The depreciation number on that set of financial statements actually relates to the cost of replacing their plant and equipment. So you can trust that depreciation figure much more than you can in a small business. And I know a lot of the people here at the conference are from the States. So in the United States, there's a lot of opportunities to do accelerated depreciation, which means you could buy a lot of equipment and depreciate it all at once, and then you end up with no depreciation on your income statement. So as a business buyer, when you're looking at one of these businesses, if you look at a business that only owns like one major piece of equipment, what then should you be using as a stand-in for depreciation? Well, what I've come to use is leasing. And so this is since Nunzio's in Ontario, I decided I would Canadianize this as much as possible. So this is from the Government of Canada, and this is a vehicle lease calculator that I found. And so I put in, for example, the 100,000 truck over an 8-year period, and it came up with a number of 14,272. And so if you think about an auto lease, what an auto lease is, in essence, is simply a combination of interest and depreciation because the finance company is earning some kind of rate of return. That's your interest component. And they're certainly covering the cost that they put into buying it over the course of the lease. That's the depreciation. But what it does is it smooths it out in a straight line for us. And so when people are looking at buying a business, what I'll say is pick out the biggest, most complex and expensive pieces of equipment in the business. And for a lot of small businesses, there could just be a handful of these items. A truck, a fancy machine that does something, just a few pieces. And I'll say, let's figure out what it would cost you to lease them and what their normal lifespan is. And let's use this as a stand-in figure for depreciation for using our EBIT level of cash flow. And so here's what I recommend you guys do from the point of view of a buyer. So you look at a business, you interview the seller, you talk with them about the business, you figure out that you like the business and you want to own it, let's say. So, well, use your benchmark from the notional cash flow. So if you're going to buy a trucking company, many trucking companies are priced at 5 times EBIT, right? If you're going to buy a small retail store, then you're probably looking at 2.2 or 2.3 times SDE, right? So just use that benchmark to start. Figure out how you're going to finance the deal. So now you figure out what your loan's going to be, etc. And we're going to make two different models here. We're going to subtract the fair market value of an owner manager role. So imagine if I'm going to do the work there every day, how much do I need to earn? What is the fair value of that role? So if you are a systems engineer and you're used to earning $200,000 a year, but you try to buy a dry cleaner, don't jam your $200,000 salary into that line. What should a dry cleaning manager earn? We want fair market value for the work you're going to be doing. Okay. So then we are going to estimate the depreciation versus the CapEx budget. So the CapEx budget is that leasing trick I just taught you. Estimating the depreciation takes a little more forecasting thought. You might actually think, if I'm buying this business and I'm getting all of the equipment free and clear, when will I likely have to acquire more equipment? If it's an asset purchase, what will the allocation of my purchase price be to the equipment? And then you can actually work out your own depreciation. And you can figure out, in 3 years, I might have to buy another piece. What will that do to my book value, et cetera? So you're doing a cash flow forecast to figure it out, because you're going to end up with different numbers than the CapEx budget I just taught you. Okay. But you want to know what both of these are. Then you're going to subtract the interest. I didn't say debt service. I said just the interest. So when you're calculating your debt service, you're going to want to maybe make an amortization table so you can see what the interest versus the principal amounts are. Because the interest is an expense for tax purposes. Principal is not. You borrow money from the bank tax-free, it goes back as a non-tax event as well. So by knowing the depreciation and knowing the interest you're going to pay, then you're going to be able to calculate your tax bill. You won't believe how many people will end up with a relatively small amount of money after looking at debt service and go, look, see, I'm still ahead. And they'll say, what kind of taxes do you have to pay? And the person's in California or something, they've got a really high tax jurisdiction. Then after you look at subtracting the taxes, you can subtract your loan principal. And then you ask yourself, how much is left over? And does it give you a sufficient return on your initial cash down payment? That's the equity. So what we're looking at here is not ROI, it's ROE, return on equity. That's this small and medium-sized business free cash flow. So we're going to work one out. And again, sorry about the slides. These are supposed to pop up one at a time. So we got an asking price of $7.99. Let's say you offer $7.50 and it works out to an SDE multiple of 3.25. And if our down payment is quite generous at 25%, and we have a bank loan at 9% over 84 months, that's going to give us a payment of $72,000 a year with interest in the first year of $32,000. And if our seller note is at 8% over 36 months, that is going to be $70,000 in payments in the first year with $14,000 in interest. So let's look down the line here and see what we got. $231,000 of SDE. He was saying that his manager was paid 45 grand. Like, in looking at this case, at looking at that business, I don't think $45,000 was a reasonable salary for a manager. So I increased it to 60, right? And you will find people that are underpaid, and you will find sellers that think that the wages paid 10 years ago are still current, right? But in my case, I thought, no, the real wage for this kind of role is 60 grand. That leaves us an EBITDA of 171. That truck lease calculation that we did was 14.2. The bank loan is 72.4. The seller note service is 70,500. The taxes in Ontario, assuming a small business corporate tax rate of 13.2%, because remember, a big part of the loan service is principal. That's part of your profit, right? So you still have to pay tax on it. So this company would have a tax bill of 14.6 and end up, the buyer would have to go find 120 bucks by looking through the cushions on the couch looking for change to cover the deficit, because there's not enough cash flow in this scenario, right? So how could we be so terribly, terribly wrong? How can this system have gotten so off kilter in such a bad way? Well, remember this slide? And I said, the broker took the 231 and multiplied it by 3. So 3 times cash flow is a typical multiplier of EBITDA, not of SDE. And I see people making this mistake all the time. In fact, several times I've seen people on Twitter say, I just closed on a deal. We paid 3.1x. And I'll reply to their tweet and say, is that SDE or EBITDA? And they'll say, what do you mean? And I'll say, well, if it's SDE, it may not cash flow. And this is a mistake that people make, is they confuse, and I think I saw someone in the comments make this comment too. This is a mistake people will make, is they will transpose SDE and EBITDA multipliers, and they'll get them confused and they won't know which is which. It's very, very important. In the world of SDE, anything above like 2.5 is getting expensive, very expensive, because the owner's salary is included in SDE. And when you look at EBITDA multipliers, it's a whole different league. Small businesses might sell for 3 times EBITDA, and machine shops with a lot of equipment might sell for 4 times. And some business with some intellectual property, a patent or something, might sell for 5 times. By the time you get to 8 times EBITDA, you're talking about junior publicly traded companies traditionally. The last few years has been a bit, inflated, but traditionally, junior publicly traded companies could start in that 8 times multiple. So here's how it should actually look. Okay. So here's an example. Asking was $7.99, offered $5.25, which creates an SDE multiple of 2.27. And our down payment in this case is only going to be 131. And the bank loan is going to be 262. But you'll notice here, I changed the seller note from 36 months to 48 because I needed more free cash flow. And so it lowered the payment. And when we get over here, we see SDE of 231, my $60,000 salary. There's the EBITDA of 171. And then we have our truck lease, our bank loan, our seller note. Look at this. The corporate tax rate is up, right? Because our interest expenses are lower. So we actually end up paying more in taxes. But look at the free cash flow, $51,000 in free cash flow. And that 131 that we put down, we're going to be able to recapture that in 2.5 years. Remember, guys, small businesses are the riskiest asset class that there is, bar none. All kinds of things can happen in the world of small business. Major national competitor can open up across the street from you. If you're I've seen restaurants fail because cities decided to replace sewer pipes in front of them and took 8 months during the busiest time of year, completely out of the control of the owner. All kinds of risks exist in the world of small business, and this is why they traditionally sell for low multiples, and you've got to be able to get your cash back out. Like, you don't know what the future holds. So in this second to last slide, these are the key takeaways that I want you guys to have. Regardless of the multiple, the deal must sufficiently cash flow. There has to be a good amount of money coming out of it for you. Otherwise, why are you buying it? I mean, you buy a business to reduce risk so that you already have customers and sales and all that kind of stuff. But if you don't set it up properly, and I see Ted Leverett making comments in there, and he always says that if you buy the right business the wrong way, you can end up in trouble. And I agree totally, because if you buy the right business the wrong way and you're over leveraged or you commit too much cash flow to debt service, then you can just put yourself in the same risky position that any new business startup is in, where a tiny 5 or 10% decline in sales, top line revenue, which happens all the time in the world of small business, a tiny decline in top line revenue can wipe out a good chunk of your profit. And all of a sudden, you can't pay yourself. You don't want to be in that position. There has to be meat on the bone for you as the buyer. Even with the principal being part of the profit, it can take 5 to 10 years to pay off all your acquisition debts. You guys in the States, SBA financing, takes 10 years to pay back. You are exposing yourself in a 10-year period. You're almost guaranteed to go through one entire business cycle. We're all talking about a recession next year, but people who bought 5, 6 years ago on a 10-year loan should also have been aware that they would definitely be going through a recession at some point during the life of that loan. Okay. And so it's got to cash flow even with the debt service. You can't rely on a small business having infinite life like Coca-Cola might. Completely different ballpark. And then I asked the question, are you still going to be in business by the time you're finished paying off the note? Small business is risky. And like I said, I've seen all kinds of stuff. And if you go to my YouTube channel, I've got videos on there where I talk about the kinds of stuff that can get you and stuff that I've seen. So just in the years that I've been working with people doing these transactions and helping my own clients as a broker and then as a consultant as well, I've just seen these unforeseen things. And of course, the biggest one of all that surprised everyone was the COVID that happened just a couple of years ago. You know, who would have seen that coming? But if you bought a restaurant, in December of 2019 and you used 90% leverage or a lot of loans or something, you would have been in serious trouble. And, you know, a lot of the people who made it through there, just did it because of, maybe some government assistance programs and things like that. So with that, again, I apologize about the slides, everyone. The images weren't showing when I had it in presentation mode, but there are some things that you can do with your phone. It's very cool. I saw it in a live presentation a few weeks ago, and I wanted to be like that. So I've got the QR codes as well. And with that, I guess we'll go have some questions. And again, that dbarnett.gumroad.com/L/bossup2023/free will allow you to download the slides and a bunch of other goodies that I put together in there. But I'm going to stop sharing. And maybe should I scroll back perhaps and look at some of these? See, some of you guys were saying stuff in the comments and you were getting ahead of the presentation. It was almost like you were cheating and you had a set of the slides. Paul asks at 1504, why would I as a buyer value a business based on pre-tax earnings? Taxes are an expense, plain and simple. So great question, Paul, and here's why. Because people can legitimately manipulate the amount of tax that they pay, if there was a database of small business transactions of laundromats, for example, all based on what multiple of after-tax earnings were paid for the businesses, that data would be useless because we wouldn't know what the tax decisions would have been for all those operators. Like I said, the SDE is maybe presented sometimes as profit in your pocket, which it is not, but it does serve a useful function. It allows us to move back up the income statement to the point where we can actually say everything before this, all the expenses before this had to be spent for this business to function. Now we can compare it with the next one that we've done the same exercise with of normalization. And so you're going to see what businesses sell for. And I know someone else asked a question about where do you find this data? There are private transaction databases that exist where business brokers submit their sales transactions. And because I work with people in this industry, I pay to be able to access that. It's thousands of dollars a year. But just through reading articles, and searchfunder.com, for example, you can access transactions now through Deal Stats, I think. And there's other sources out there where people will be writing articles. Take everything with a grain of salt. I think that Mike Finger in his prior presentation mentioned that he was read that businesses like his sold for 2 times revenue. Like that obviously is not correct. But if you find an article that says, laundromats typically sell for of this size sell for 2.2 to 2.3 times STE, you can be like, that's an interesting bit of data. I wonder if it cash flows. And then if you find it does cash flow, then that's actually a reinforcing piece of information for you. And the other thing is that the multipliers change as the size of the business changes. So a restaurant that has $1 million in sales is going to have a different set of multiples than a restaurant with 3 million in sales. The bigger enterprise is going to be seen as less risky in the marketplace, and people are going to be willing to pay more for that cash flow than the smaller restaurant. Your Nevins benchmarks are too often interchanged from SDE to EBITDA. Yep, that's right. Um, how do I download the slides from this? I put the link in the chat, Richard. It's the Gumroad link. Hey, Anthony. Um, Ted, debt service coverage ratio. Yep, um, and so debt service coverage ratio is a tool that banks use. Banks that make loans on small business understand the problems. They've had people default. They've looked at the cases, and a lot of the times they'll make their own rules. So I know that there are some bankers who will have different debt service coverage ratio rules. I find a lot of them are way too liberal, like way too low. I think that many of the debt service coverage benchmarks you should be aiming for should be higher than what some banks are asking for. There are also some banks that will put in certain minimums with respect to capex, and again, it's because they know depreciation has been added back. And someone in here must have quoted Warren Buffett. Um, Warren Buffett says he'll look at EBITDA as soon as magical fairies start paying for his equipment or something like that. That's exactly it. Is you have to pay for equipment with real money. It's a real cost. You might be able to push it off, you might be able to defer, but one of the common scenarios that I see is that people who know they're going to sell their business will defer those reinvestments. Um, and then you end up in a situation where there's more to replace. And if that's the situation, you have to look at lowering your offer price, because if you have to go in there in the first year and spend a lot of money on replacing equipment, it's got to come out of what you pay the seller, because the business literally isn't worth as much because the reinvestment hasn't been made. How would you view John Baker at 1543? How would you view variable interest rates, specifically SBA 7A debt, in this environment when thinking about buying a business? Um, Variable interest rates are obviously scary, John. And so the answer is to have it blended with more fixed rate debt. And one of the only places you're going to find fixed rate debt is if you remortgage like your house or something like that, which means putting additional collateral up in the case of coming up with your money, or the seller financing, right? So you can say to a seller, I can't afford to pay you as much because if I assume that interest rates could continue to go up, like, hey, if SBA loans are at 10% today, do your calculations based on 13% and say to a seller, if rates go up a couple more points, I can't afford to pay this. But if you carry more paper for me at a fixed locked in rate, then I can afford to pay a little bit more potentially because I will have less risk in credit rates or interest rates going up. Um, Paul Tierney, so accelerated depreciation leads to a lower tax burden. Yep, absolutely. And that was why when President Trump introduced the Trump tax reforms, they created a lot more opportunities for accelerated depreciation because they were trying to encourage businesses to reinvest in capital. They wanted small business owners to go out and buy trucks and buy machinery and buy equipment. Was how they were going to stimulate the economy. And so why would a business owner, take 100 grand and buy something? Well, if I can reduce my income by 100 grand and then save the taxes, then that's like an incentive for me to go and spend money. Now, what a lot of sellers don't particularly know is that when you buy a business in an asset sale, there needs to be an allocation of the purchase price, which means that, in the case that my example here, $525,000, that's going to be broken down. How much of it is for equipment, how much of it is for inventory, how much of it is for goodwill. And the IRS and the CRA all both say that you need to use the fair market value of the equipment. Now, does that mean a truck is worth 20 grand or 22 grand? Obviously, there's wiggle room in all of those things. But if a seller has depreciated his truck to zero and then you allocate it at 25,000, the taxes he saved by depreciating it down to zero, he now has to repay that money. He didn't do anything illegal, but the government says, oh, you've depreciated that and you saved taxes in doing so. Now that that thing worth zero was actually worth 25 grand, we want our taxes. And so this is a shock to some sellers, and it can be surprising and they don't like it. And the way to frame it when you're talking with sellers is you say, no, it's not a tax bill. You just have to repay the savings you already enjoyed by doing the depreciation you did years ago. So basically, the government was like lending them money. Now they have to give it back. Um, in addition to EBITDA and SDE, some brokers also use adjusted EBITDA. What are your thoughts on that? So I commented in the presentation, adjusted EBITDA is also a term I've often seen, which is the same as SDE. Um, yeah, Paul Tierney quoting Charlie Munger. Yeah, he's a smart, rich guy too. Warren was quoted a lot today. Uh, and I guess we're done. Awesome. It's 10-2. Joe, working capital in FCF forecast. Yeah, if you're gonna go out multiple years, Joe, and the business is going to be growing, then you're also going to forecast that you need to have an increase in your working capital. So part of your free cash flow actually can't leave the business; it's got to stay. Um, and then Parag Veda says the working capital adjustment in the purchase price. So there's a concept of net normal position in working capital, and the net normal position should be included in the enterprise value. And if you refer to the video that I pointed out in my slide presentation about inventory, there's a discussion in there about net normal position working capital. Thanks, guys. Thanks for the great feedback. Sorry about the slides. I'm not sure what happened. I don't know if it was this system we're using or if my PowerPoint just freaked out, but sorry about that. Anyway, download the slides. You can play with them at home. Good point, Jordan, about the all cash deals. Where do we download the slides? Here, I'm gonna put it in here again. Yes, Anthony just put it there. Perfect. Thanks. Awesome. Well, that's great. Thanks for joining me, everyone. I'll download the slides. If you want some good feedback about Excel, there's an offer in there for my cash flow forecasting program, and you should check it out. I don't believe in templates. Uh, every business has its own unique characteristics. And in that particular program that I mentioned, I teach people from a blank sheet how to build an accurate cash flow forecasting model for a small business. And I have 5 different example companies that I talk about through that, but there's an intro video over there that you can see. But that would definitely be an answer to what you're talking about there. Michael, awesome. All right, everyone, we'll see you later.